Welcome back to the deep dive. If you're getting close to retirement, or maybe you're already there, that feeling, the market roller coaster.
Oh, yeah. It's palpable.
It really is. And that anxiety when it's your retirement savings on the line, well, it's something else entirely. We all want to get rid of that feeling, right?
Absolutely. It's probably the central challenge, wouldn't you say, for modern retirement planning.
I think so.
And the tragic part, that fear, it often pushes people to make the worst possible decisions.
Yeah.
Just awful, wealth-destroying moves right when they shouldn't.
Like panic selling.
Exactly.
Yeah.
Panic selling, we see it wipe out years, sometimes decades, of really disciplined saving. It's heartbreaking.
It is, and that's exactly why we wanted to tackle this head-on in this deep dive. We've looked at some really compelling source material.
They have.
Focusing on strategies that fiduciary financial advisors use, not just to market-proof a portfolio, but to make it genuinely resilient, designed to thrive over the long haul.
And our mission today, really, is to give you a shortcut to that understanding. A comprehensive one. We're zeroing in on 7 specific strategies. Proven ones.
Okay, 7 strategies.
But, and this is key, this isn't just generic advice you could find anywhere. These strategies are tailored specifically for people planning retirement or already living in Florida.
Ah, the Florida angle.
Precisely. Capitalizing heavily on the unique legal and tax advantages that Florida offers. It's quite distinct.
So we're not just talking about, weathering a storm. We're aiming higher.
Much higher.
Creating a whole financial architecture that actually leverages Florida's environment to lock in long-term security, no matter what the S&P 500 does next week.
That's the goal. Comprehensive wealth management insights. Insights to help, bulletproof your retirement plan.
Bulletproof, I like that.
And the absolute best place to start. It has to be the single biggest advantage Florida gives its residents from a legislative standpoint.
Okay, let's do it. Let's unpack strategy number 1. Leveraging Florida's, frankly, incredible zero-state income tax.
Yeah.
And using that for really strategic, tax-smart withdrawal planning.
It's just a monumental advantage. I honestly don't think most people fully grasp the power of it.
Really?
Think about it. If you live in California, New York, maybe Oregon.
Right.
I tax states, right?
Right.
Every dollar you pull from your retirement accounts, the state can take 5, 8, even 10% or more sometimes.
Ouch.
But if you're a Florida resident, that money stays with you. Every penny, after federal taxes, of course.
Zero state income tax.
Zero. That translates directly into, massive immediate savings on cash flow. And it opens the door for some really sophisticated tax planning.
Right.
The flexibility is unparalleled.
Flexibility. Okay, so that's the key word. Because we're not just saying pull money out evenly from all your accounts, are we?
Oh, definitely not.
Yeah.
That's far too simplistic. We're talking about the sequence of withdrawal.
Sequence. Got it.
The most tax-efficient way to do it. Generally, it's to front-load your withdrawals from your taxable brokerage accounts. The ones you hold outside of IRAs or 401k. Do that in the early years of retirement.
Okay, taxable accounts first. Why?
Because those funds, usually, they're taxed at the lower long-term capital gains rates.
Yeah.
Much lower than ordinary income rates.
Right.
You only start tapping into your traditional IRAs or 401k,
Right.
the ones taxed as ordinary income later on. Or, only when you absolutely need to supplement.
Okay, so what's the deeper thinking behind that? Taxable first, especially if the market's shaky. Isn't there sometimes a view to let taxable accounts grow?
Well, the goal is really twofold here. First, psychologically, maybe you're pushing the bigger tax hit down the road, delaying it.
Okay.
But second, and this is critical from a planning perspective, you're actively suppressing your adjusted gross income, your AGI, during those early, maybe more vulnerable retirement years.
Suppressing AGI, how does minimizing those traditional IRA withdrawals help there?
By minimizing those ordinary income distributions, you keep your overall federal taxable income lower, which means potentially staying in a lower federal tax bracket.
Right.
But it's not just about the income tax rate itself. Keeping that AGI lower helps you avoid some potentially really costly penalties. Things like IRMAA.
Ah, yes, IRMAA. Okay, now we're getting into the weeds of high-level planning. For listeners who might not know, what exactly is IRMAA and how does controlling AGI help save money there?
Good question. So IRMAA, it stands for Income-Related Monthly Adjustment Amount. It's basically the government's way of charging higher income retirees more for Medicare Part B and Part D.
So higher income means higher Medicare premiums.
Exactly. And the income thresholds, they don't go up much each year, not really indexed generously. And the penalties and the extra premiums, they can be substantial. We're talking hundreds, even thousands more per year.
Wow.
So if your AGI crosses one of those thresholds, maybe because you took a big unplanned withdrawal from your traditional IRA to cover, say, a new roof well 2 years later, bam, your Medicare premiums jump up.
2 years later, why the lag?
They base it on your tax return from 2 years prior. That's just how the system works. So by strategically keeping your AGI low, using that withdrawal sequencing we talked about.
Taxable accounts first.
Right. You don't just pay less federal income tax today. You potentially save thousands a year in future Medicare premiums. It's huge.
Okay, so that completely shifts the focus. It's not just tax rates. It's managing future health care costs, too. Very strategic.
Precisely. It's holistic. Now, this idea of keeping AGI lower also creates another really interesting opportunity, especially in Florida.
Which is?
Roth conversions. Florida is, frankly, the ideal place to execute Roth conversions.
Yeah.
Why? Again, because the state doesn't take its own bite out of the amount you convert. No state income tax on the conversion itself.
Okay, Roth conversions. So moving money from a traditional tax-deferred account to a tax-free Roth. Let's talk timing, though. Our sources say convert during low-income years. Okay, that makes sense. Or during market downturns. That sounds counterintuitive. Why convert when the market's crashed?
It does sound odd at first, but let's walk through an example. Makes it clearer.
Okay.
Say you have $100,000 in your traditional IRA. It's invested. The market tanks, drops 20%.
Okay.
So that account's value is temporarily down to $80,000.
Right. Painful but temporary, hopefully.
Hopefully. Now, if you decide then to convert that entire $80,000 to a Roth IRA, what happens?
You pay income tax on the conversion.
But only on the $80,000, the current depressed value. You're essentially locking in the tax hit at a lower point. Think of it like buying future tax-free growth on sale.
Ah, I see. You've paid tax on 80K, but you still own the same number of shares, which were originally worth $100.
Exactly. So when the market recovers, and historically broad markets do recover, that $80,000 climbs back to $100,000, maybe $120,000, maybe $150,000 over time.
All that growth. The $20K recovery, the extra $50K on top.
Completely. 100% tax-free. Forever.
Right.
Tax-free withdrawals in retirement. That $70,000 gain in our example, never taxed.
That's powerful. You're paying the tax bill when the assets are on sale, so to speak.
That's a great way to put it. It's opportunistic conversion. It's proactive. You're future-proofing a chunk of your portfolio against, well, future market ups and downs, yes, but also against potentially higher tax rates in the future. Who knows what Congress will do?
Good point.
It ensures that a significant part of your nest egg grows entirely outside the tax system. Huge for long-term security.
Okay, that's a fantastic foundation. Using the tax code, especially Florida's code, really proactively. But tax savings alone, that's not the whole picture, is it? We need defense.
Absolutely not. Defense is critical. Which brings us right to strategy number 2, building an absolutely impenetrable cash reserve.
Impenetrable. Okay.
This is your firewall, your financial shield. I'd argue it's maybe the single most important strategy for protecting yourself from yourself,
Yeah.
from behavioral mistakes.
How so?
If you don't have this cash reserve, you are fundamentally exposed to a lethal financial threat. And that is being forced to sell your long-term investments at the absolute worst time. Selling low simply because you need cash to pay the bills.
Right. The classic mistake. Now, for younger folks, the advice is often, a 3-month emergency fund. Is that enough for a retiree, or do we need more?
Definitely need more.
Yeah.
We're talking about retirement level protection here. The reserve needs to be robust. Our sources typically define robust as 3 to 6 months worth of your essential uncovered living expenses.
Uncovered expenses, meaning?
Meaning the expenses that aren't covered by other guaranteed income sources, like pensions or Social Security. It's the gap you need to fill from your portfolio.
Got it. 3 to 6 months of that gap. And where do you keep this cash? Not under the mattress, I assume?
Please no, not under the mattress. It needs to be safe, yes, but also easily accessible and, ideally, earning something, even if modest. So think high-yield savings accounts, maybe short-term treasury bills or money market funds. Safety and liquidity are paramount here. The return is secondary.
Okay, safe and liquid. Now, the critical part. When and how do you actually use the shield?
The rule requires discipline. You deploy this cash reserve only when your long-term growth portfolios, your stocks, your mutual funds, takes a significant hit. Let's say a drop of 20% or more. That's a common trigger point.
So market down 20%. Alarm bells ring.
And instead of selling stocks or funds to pay your mortgage or buy groceries that month, you draw from the cash reserve instead.
Ah, okay.
This is absolutely vital. It prevents what planners call the crystallization of losses.
Crystallizing losses. That
Yeah.
sounds bad. Explain why doing that selling after a drop is so damaging long term.
Because when you sell an asset that's down 20%, you permanently lock in that loss. That 20% is gone forever. It cannot participate in the eventual market recovery.
Right.
Think about it. If you sell $100,000 worth of stock that's dropped to $80,000 to cover expenses, that $20,000 loss is now real. It's fixed. To get back to your original $100,000, the remaining $80,000 now needs to grow by 25%, not just 20%, just to break even.
Wow. Yeah, the math works against you harder after a loss.
Exponentially harder. This compounding damage, needing much higher future returns just to catch up, that's what truly derails retirement plans permanently.
So the cash reserve is like a bridge. It buys time, lets the market potentially recover without you being forced to sell low and lock in those losses.
Exactly, a bridge. It allows your investments the time they need to heal. And don't underestimate the psychological benefit either.
How so?
Knowing you have 6 months of bills covered, safely parked away from the market chaos, it brings immense peace of mind. It short-circuits that panic-selling impulse, that urge to just stop the bleeding by selling everything.
Which, ironically, guarantees you bleed more in the long run.
Precisely. It stops investors from falling into that classic trap. Sell low, wait until things feel safe again, then buy high. That cycle destroys wealth.
That psychological discipline, it feels very connected to another strategy you mentioned, strategy 4, implementing disciplined annual rebalancing.
Absolutely linked. Discipline is the common thread.
This one tackles portfolio drift, right? Explain what drift is.
Drift is just the natural consequence of markets not moving in lockstep. Imagine stocks have a great run for 5 years, while bonds kind of tread water, which happens, right? So a portfolio you carefully set up to be, say, 60% stocks and 40% bonds might naturally drift just due to market performance to become maybe 75% stocks and only 25% bonds.
Without you actively doing anything.
Exactly. You become unintentionally more aggressive, more exposed to stock market risk simply because your stocks did well. Your personal risk tolerance probably hasn't changed, but your portfolio's actual risk level has crept up.
So your success kind of undermines your original plan in a way. How does rebalancing fix that systematically?
Rebalancing forces a regular checkup. It mandates a comprehensive portfolio review, ideally at least once a year, though some do it based on percentage drifts too.
Okay, review annually. And then what's the action?
The action is simple in concept, but can be emotionally tough. You systematically sell some of the assets that have become overweight, in our example, the stocks that performed well.
Sell the winners.
Sell some of the winners. And you use those proceeds to buy more of the assets that have become underweight, the ones that underperformed in our example, the bonds, or perhaps other sectors that lagged.
Okay, I have to ask the question I know listeners are thinking. If the market's tanking, stocks are down 25%, maybe bonds are flat or even up a little, rebalancing tells me to sell the bonds, the one thing working, to buy more stocks, the thing that's plummeting. That feels wrong. How do you get past that mental hurdle?
That is precisely the point where discipline takes over from emotion. And it's why rebalancing is so powerful, yet so hard for people to do on their own.
It's counterintuitive.
Deeply counterintuitive during times of stress. But think about what you're actually doing. Rebalancing is fundamentally a contrarian strategy baked into your plan. It forces you systematically to do what every great investor says to do. Buy low and sell high.
Ah, because you're selling the asset that ran up, selling high, and buying the one that fell, buying low.
Exactly. When fear is gripping the market and quality assets are on sale, your rebalancing rule mandates that you buy them at those discounted prices. It takes your emotions completely out of the equation.
Like an automated discipline mechanism.
Perfectly put. And history shows very clearly that this systematic, unemotional approach has rewarded patient investors. Over the long term, disciplined rebalancing tends to lead to superior returns compared to just letting the portfolio drift wherever the market winds blow it, or worse, making emotional trades.
So it's basically automating the buy low, sell high mantra that's so easy to say and so hard to do in a crisis.
That's a great summary. And crucially, it brings your portfolio back to its original intended risk level, the one you were comfortable with from the start, ensuring you don't end up taking way more risk than you planned just because stocks had a good run.
Okay, that makes a lot of sense. So we've covered tax strategy, cash reserves, rebalancing discipline. Let's broaden out now. Strategy 3. Diversification, but with a specific Florida real estate flavor.
Yes, moving beyond just stocks and bonds. Smart diversification today really needs to consider other asset classes, ones that maybe don't move in perfect sync with the stock market. And Florida real estate is a compelling one.
Why Florida specifically?
The state's economy has some unique drivers. Persistent population growth, people keep moving here. A massive tourism sector, increasingly corporate relocations too. All this creates underlying demand that makes real estate potentially attractive and maybe less correlated day to day with Wall Street.
Okay, but the idea of becoming a landlord in retirement, dealing with tenants, repairs, midnight calls, that doesn't sound like a relaxing retirement plan for most people.
And it doesn't have to be. That's a key point. The sources we looked at strongly suggest focusing on indirect exposure first, primarily through real estate investment trusts or REITs.
REITs. Okay, tell us more about those.
Think of REITs as mutual funds for real estate. They allow you to buy shares, just like a stock, and own a piece of a diversified portfolio of properties. Could be apartment buildings, shopping centers, hospitals, data centers, warehouses, all managed professionally.
So you get the potential income and appreciation of real estate, but without the landlord headaches.
Exactly. No calls about leaky faucets. Now, there are different types of REITs, of course.
Right. Which ones are generally better suited for, say, retirement income stability?
Good question. Generally, we distinguish between equity REITs, the ones that actually own and operate buildings, collecting rent, and mortgage REITs, or AM REITs, which mostly deal in mortgages and mortgage-backed securities.
Okay.
For retirement resilience, equity REITs are often preferred, especially those focused on essential sectors, things people need regardless of the economy, like healthcare facilities, senior housing, maybe industrial logistics centers, even data centers. Their income streams tend to be more stable and predictable than, say, retail or office REITs, or the more interest rate sensitive REITs.
And can you target Florida specifically with REITs?
Absolutely. There are many REITs, both broadly diversified national ones with significant Florida holdings, and even some that focus very specifically on high-growth Florida markets. Think Miami-Dade, Orlando, Tampa, Jacksonville. So you can directly participate in the state's economic engine through these vehicles.
Okay, so REITs for indirect exposure. What about other ways to diversify fixed income, again, tying back to Florida's tax situation?
Right. This brings us to municipal bonds, or munis as they're often called.
Munis? Bonds issued by state and local governments.
Exactly. And they offer a really unique tax advantage, especially powerful when combined with being a Florida resident.
We know Florida has no state income tax, so how does that make munis even better?
Because the income from most municipal bonds is exempt from federal income tax. That's the main draw nationally, especially for people in higher tax brackets.
Okay, federally tax-free.
But now, layer on Florida residency. If you, as a Florida resident, buy municipal bonds issued by entities within Florida, say the state itself, or a Florida county or city,
So Florida-issued bonds bought by a Florida resident.
you achieve what financial planners often call triple tax-free income.
Triple tax-free. How's that work?
Well, the income is 1, exempt from federal income tax, 2, exempt from Florida state income tax because Florida doesn't have one anyway, and 3, usually exempt from any local income taxes if applicable, though less common in Florida.
Wow. So basically, completely tax-free income if you buy the right munis and live in Florida.
For generating reliable, generally lower-risk fixed income, it's incredibly efficient. It reduces your dependence on the more volatile stock market for income,
Yeah.
and it aligns perfectly with Florida's overall tax-friendly environment. It's about building multiple, differently behaving income sources.
Reducing reliance. That's the perfect segue into strategy number 5, creating guaranteed income foundations. This sounds like building a floor beneath your retirement finances.
That's exactly what it is, a financial safety net. And it's hugely psychological, too.
How so?
Market swings feel a whole lot less scary if, with certainty that your essential living expenses, your housing, food, utilities, basic needs are covered by income that has zero connection to whether the stock market went up or down today.
Okay, so how do we build that guaranteed floor? What tools are we talking about here? Annuities.
Annuities are definitely a primary tool for this. Various types exist. The simplest might be a single premium immediate annuity, or SPIA.
SPA.
Yeah. You give an insurance company a lump sum of money, and in return, they guarantee to pay you a specific amount, say $2,000 a month or $24,000 a year for the rest of your life, no matter how long you live or what the market does.
Okay, so that $24,000 is locked in.
Locked in. So if your core essential expenses are, say, $30,000 a year, and you have $24,000 guaranteed from the SPIA, now your investment portfolio only needs to generate the remaining $6,000 for essentials. That dramatically lowers the pressure on your stocks and bonds, especially during downturns. You don't need them to perform right now for survival.
Yeah, I get that. But annuities, they sometimes get criticized for being complex or having high fees or locking up money. Are there options that offer guarantees but maybe keep some flexibility or upside potential?
Yes, absolutely. The annuity world is broad. You can look at things like fixed index annuities or variable annuities that have optional riders. One particularly relevant rider for this discussion is a guaranteed lifetime withdrawal benefit, or GLWB.
GLWB, okay. That's a mouthful. What does it do?
It is a bit complex, and yes, these riders add cost, but they offer a very specific, powerful protection, especially against retiring at the wrong time.
Retiring into a downturn.
Exactly, sequence of returns risk. Here's how a GLWB typically works. It guarantees you can withdraw a certain percentage of your initial investment each year for life, even if the underlying account value drops. But critically, many GLWBs include a feature that periodically locks in the highest value your account reaches the high water mark.
High water mark.
Yeah. So imagine you retire, put money into this annuity with a GLWB, and the market is at an all-time high. Then, boom, the market drops 30% the next year.
Ouch. Nightmare scenario for a new retiree.
It is. But with the GLWB high watermark feature, your guaranteed lifetime withdrawals are based on that peak value your account hit before the crash, not the new, lower value.
So it shields your income stream from that immediate market loss.
Precisely. It directly mitigates that sequence, risk the danger of depleting your portfolio too quickly due to early losses combined with withdrawals. It ensures you have that reliable income baseline, allowing the rest of your portfolio, the growth part, the time and space it needs to hopefully recover without being constantly drawn down for living expenses.
Okay, that's a really important layer of defense. So we've built portfolio defenses. Cash, rebalancing, diversification, guaranteed income. Now let's shift gears slightly. The last couple of strategies seem to look beyond just the investment portfolio itself. Strategy 6, developing multiple income streams.
Yes, this is about creating true financial flexibility and reducing reliance altogether. If you have income coming in that's not dependent on investment returns, market volatility just becomes less relevant, less threatening.
It gives you options.
Huge options. Maneuverability, especially during uncertain market periods.
So what kinds of supplemental income are we talking about? Are people really going back to work full-time in retirement?
Not necessarily full-time. Often it's about leveraging skills and experience built over a career, but on your own terms. Think part-time consulting in your old field, project-based contract work, serving on a board, maybe turning a lifelong hobby into a small income stream.
Lower commitment, maybe, but still generating cash flow.
Exactly. The goal isn't always to replace your entire pre-retirement salary. Sometimes just covering property taxes or travel costs or those Medicare premiums we talked about.
That can be enough.
Enough to allow you to delay tapping into your investment portfolio during a dip.
And this supplemental income, it enables perhaps the biggest power move of all in retirement planning, doesn't it? Delaying Social Security.
Ah, yes. If there's one guaranteed way to boost your retirement income for life, this is arguably it. Delaying claiming your Social Security benefits.
How does having other income streams help with that?
Simply because if you have, say, $20,000 a year coming in from part-time work, you might not need to start taking Social Security at age 62 or your full retirement age, say 67. You can afford to wait.
And waiting is valuable. We often hear that 8% figure. What does that mean practically?
It means for every single year you delay claiming Social Security past your designated full retirement age, up until age 70, the government increases your future monthly benefit by approximately 8%.
8% per year. That's huge.
It's massive. And critically, that 8% annual increase, it's on top of any cost of living adjustments. So it's an 8% real increase compounded. And it lasts for the rest of your life and potentially your surviving spouse's life, too.
So you're essentially buying a larger inflation-adjusted pension from the government by waiting.
That's a perfect analogy. You are getting a guaranteed risk-free return of 8% per year on those deferred benefits. Show me any investment portfolio that can guarantee an 8% return risk-free. You can't.
Doesn't exist. So if you can cover, say, 3 to 8 years of living expenses with part-time income, allowing you to delay Social Security from 62 or 67 up to 70, You've potentially increased your largest, most reliable inflation-proof income source by a significant amount.
Dramatically, making future market volatility much, much less of a personal financial threat. It's just brilliant financial engineering, really, using the system to your advantage.
Okay, phenomenal strategy. Now let's wrap with the final piece, Strategy 7. Implementing strategic estate and healthcare planning. This feels like the umbrella strategy, protecting the whole picture.
It really is. Think of it as reinforcing the entire structure from external shocks. Market volatility becomes less concerning if you've minimized other potential financial drains or complications.
So simplifying things and reducing obligations makes downturns less scary.
Exactly. When you streamline how your wealth will be managed and transferred, and protect yourself against catastrophic, non-market-related expenses, you ensure that some unexpected emergency doesn't force you into making bad investment decisions at the worst time.
Okay, let's break that down. What's arguably the biggest potential external financial shock for retirees? Healthcare costs, right? Especially long-term care.
Without a doubt, an extended stay in a nursing home or needing years of in-home care, the costs can be astronomical, easily hundreds of thousands of dollars. Enough to wipe out even a well-funded portfolio very quickly if you're paying out of pocket.
So what's the protective tool here?
The primary tool is long-term care insurance, or LTC insurance. And like delaying Social Security, the timing here is critical.
When should people ideally look into getting it?
The advice from the sources is pretty consistent. Ideally, you purchase it in your early to mid-50s.
Why so early? Isn't that decades before you might need it?
Yes, but the premiums are based heavily on your age and, crucially, your health at the time you apply. If you wait until your 60s or later, the chances you've developed a health condition, maybe diabetes, heart issues, cognitive concerns, increase significantly.
Which means higher premiums.
Much higher premiums, or you might even be denied coverage altogether. By buying it younger, while you're likely healthier, you lock in a lower premium rate for the life of the policy, generally. And you ensure the coverage is actually in place if you need it later.
So it's insurance against needing care, but also insurance against being forced to sell investments during a downturn to pay for that care.
Precisely. It's an asset protection strategy as much as a healthcare strategy. It prevents a health crisis from becoming a portfolio crisis.
Makes sense. Okay, what about the estate planning side? How does that connect to market resilience, especially leveraging Florida's laws?
Florida has some very favorable laws for residents. The homestead exemption, for example, can provide significant protection for your primary residence from creditors. That's a big one. But beyond just asset protection, the key for resilience is often simplifying the transfer of wealth and avoiding probate.
Probate. The court process after someone passes away. Why is avoiding that important for market resilience?
Probate can be slow, it can be costly, and it can freeze assets while the court process unfolds. Sometimes for months, even a year or more in some cases, depending on complexity and the county.
Assets are frozen.
Right. So if an unexpected expense comes up for the estate or the heirs during that frozen period and the market happens to be down, it could force hurried, suboptimal decisions about liquidating other parts of the portfolio that aren't frozen just to raise cash.
I see. So how do you avoid probate, especially for Florida assets like real estate?
The most common tool is establishing a revocable living trust. You transfer ownership of your assets, your house, your brokerage accounts, etc., into the trust during your lifetime. You still control everything as the trustee. But upon your passing, the successor trustee you named can manage and distribute the assets according to your instructions, completely bypassing the probate court system.
Yeah.
Much faster, private, and avoids that potential asset freeze during a volatile market.
Exactly. It ensures continuity and protects assets from being forcibly sold due to administrative delays or legal tangles right when the market might be unfavorable.
Okay, and any other key planning tools under this umbrella, maybe related to taxes or charitable giving?
Yes, strategic charitable giving ties in, using tools like donor-advised funds or DAFs.
DFs, how do they help with resilience?
A DAF allows you to make a charitable contribution, now maybe donating appreciated stock, which is very tax efficient, and get an immediate income tax deduction. This helps reduce your current taxable income, helping manage that AGI we talked about earlier.
Reduction now.
But you don't have to decide which specific charities get the money right away. The funds sit in the DAF account, can potentially grow tax-free, and you can recommend grants to your chosen charities over time, even over many years. It separates the timing of the tax benefit from the timing of the actual gift distribution. So it's tax efficiency plus supporting your legacy while keeping that AGI managed. It all seems to connect.
It all connects. Protecting wealth from unnecessary taxes, legal complications, and healthcare costs reduces the pressure points that could otherwise force bad investment decisions during volatile periods.
So if we pull this all together, these 7 strategies, it's really not about picking just one or two, is it? It's about layering them.
That's the absolute key takeaway. The most resilient retirement plans, the truly bulletproof ones, they integrate all these elements into a cohesive whole.
So you have the, say, 6-month cash reserve as the first buffer.
Right. Then you have the core portfolio, diversified beyond just stocks and bonds, maybe including those Florida-focused REITs and triple tax-free munis, and it's being disciplinedly rebalanced.
Okay.
Plus, you've built a guaranteed income floor with an annuity, maybe with a GLWB feature. You've potentially boosted your lifetime income by delaying Social Security, funded by supplemental earning.
Right.
And the whole thing is wrapped in protective layers of long-term care insurance and a well-structured estate plan using trusts and maybe DAFs.
Wow. When you lay it out like that, it's a fortress.
It's designed to be. By layering these strategies, especially leveraging Florida's unique advantages, market downturns really should shift from being potential retirement crises to just temporary portfolio fluctuations. Annoying, maybe, but not structurally damaging to your long-term plan.
Because the structure itself is built to withstand them.
Exactly.
Yeah.
Which leads to, I think, the final, most important insight we want to leave you with today.
Okay.
Successful retirement planning isn't really about trying to predict the market. Guessing if it'll be up or down next month or next year. Frankly, that's a fool's errand. Nobody can do that consistently.
Right.
It's entirely about building a financial structure, this 7-layered structure we've discussed, that is so robust, so resilient, that the market's inevitable movements, up or down, simply don't derail your life plans. Your security comes from the preparation, the architecture, not from trying to predict the unpredictable.
That really reframes the whole goal. Preparation, not prediction. That's a powerful, maybe even provocative thought to end on. It puts the responsibility firmly back on us, the individual retiree or pre-retiree.
It does. Your retirement security really depends on taking deliberate strategic action today, reviewing your current plan, seeing where the potential weak points are through the lens of these 7 strategies. Don't wait for the perfect market conditions or the perfect time, because that may never come.
So the challenge to the listener is, look at your plan now. Where's the weakest link?
Exactly. Is it the cash reserve? Is it not fully utilizing Florida's tax advantages? Maybe you haven't explored Roth conversions, or you haven't looked at LTC insurance. Just identifying one area for improvement based on what we've discussed and taking the first step. That's the perfect way to start applying these insights to build a more resilient future.
Fantastic advice. Well, thank you for joining us for this deep dive into bulletproofing retirement Florida style. We really hope you can take these sophisticated insights and apply them to build the secure, resilient retirement you've worked so hard for.